Good afternoon, everyone. Thank you for joining us today. I'm Zach, the Outreach Coordinator here at the Taxpayers Help Center, and today I'll be talking about tax considerations for families supporting an individual with a disability. The Taxpayers Help Center is a nonprofit 501c3 organization in Northridge, California. We operate two tax clinics. The first is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS. And the second is our volunteer income tax assistance clinic, where we help prepare income taxes for free. We are additionally an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. I, Zach, am the outreach coordinator, and Masood Chotani is the clinic director here at the Taxpayers Help Center. If you have questions anytime during the presentation, please feel free to email us at info@taxpayershelpcenter.com and a tax professional will get back to you. The Taxpayers Help Center helps taxpayers both locally and beyond. And since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated, and those who can volunteer their time or expertise or spread awareness are also a great help. If you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation, or if you go to the taxpayershelpcenter.com website and click on the Make a Donation tab, which I've highlighted here in red. And again, anything is greatly appreciated as these donations allow us to do what we do. So today we are going to discuss tax considerations for families supporting an individual with a disability. Families that provide care and support for a loved one with a disability often face significant financial responsibilities, and many are not aware of the tax code that contains a number of provisions designed to specifically help reduce this burden. So during this presentation, we will walk through the most important tax credits, deductions, and savings tools that are currently available, explain the eligibility requirements for each one, and highlight some planning strategies that can help protect access to public benefits while maximizing tax relief. The IRS defines a disability as a physical or mental impairment that substantially limits one or more major life activities such as walking, speaking, breathing, learning, or caring for oneself. This definition focuses on the impact of the condition rather than on whether the individual is receiving a particular benefit. To qualify for tax-related benefits, the condition must generally be considered permanent or of indefinite duration. In many cases, a written certificate from a licensed physician is required, and it's essential to keep that documentation with personal tax records in case it's needed to substantiate eligibility. It's also important to understand that the IRS uses a broader definition of disability than programs like Social Security or Medicaid. As a result, a person may still qualify for tax deductions and even credits even if they have been denied Social Security, disability insurance, or SSI. The key is demonstrating that the impairment imposes a serious and ongoing functional limitation in daily life. A permanently and totally disabled individual may be claimed as a dependent even if they are an adult and would otherwise be too old to qualify under the normal dependency rules. To claim the individual as a dependent, two primary tests must be satisfied. First, the individual must have lived in the taxpayer's home for more than half of the year. Temporary absences for educational, medical treatment, or residential care generally still count as time lived at home. Second, the taxpayer must have provided more than half of the individual's total financial support during the year. Support includes food, housing, medical care, transportation, and other basic living expenses. If both requirements are met, the individual can typically be claimed as either a qualifying child if they meet the relationship test, or a qualifying relative if they do not meet the age or relationship tests. This classification matters because certain credits, such as the Earned Income Tax Credit, are only available if the individual is classified as a qualifying child. And I'll refer back to this distinction in later slides when we discuss those credits in more detail. The credit for the elderly or disabled is a non-refundable tax credit that provides relief to qualified taxpayers or to those who support an individual who is permanently and totally disabled. To qualify, the individual must have a medically determined physical or mental impairment that prevents them from engaging in substantial gainful activity, and the condition must be expected to last continuously for at least 12 months or result in death. Eligibility for the credit is subject to two primary income tests. First, the taxpayer's adjusted gross income, AGI, must fall below a threshold that is determined by filing status. Second, total non-taxable income, such as Social Security disability benefits or certain tax-exempt pensions, must also fall below a specified limit. These limits are adjusted annually and can be found in the instructions to Schedule R. The actual credit amount is calculated on Schedule R, which walks the taxpayer through each step, including confirming disability status and determining the base amount of the credit. The base amount is then reduced by one half of the taxpayer's adjusted gross income above the threshold and by any non-taxable benefits received. Because the credit can be reduced to zero if income exceeds the limits, it is particularly important to review the phase-out rules in order to determine whether it is advantageous to claim the credit to claim the credit. And documentation of disability, including a physician statement, should be retained in case the IRS requests supporting information. So right here is a picture of the Form 1040 Schedule R, which is the form that is used to fill out this the actual credit for the elderly or disabled is calculated on this schedule. So the child and dependent care credit is designed to offset the cost of custodial care for a qualifying individual when the taxpayer must work or actively look for work. A qualifying individual may include an adult with a physical or mental disability who is incapable of self-care. This is defined as being unable to perform basic activities of daily living, including dressing, bathing, using the restroom, or eating without assistance. To qualify for the credit, the care must be provided so that the taxpayer can work and must be primarily non-medical in nature. Examples include adult daycare centers, in-home attendants who provide supervision and assistance during work hours, and specialized programs that provide daily structured supervision. Only expenses actually paid by the taxpayer are eligible. Payments made by the government, so like government programs, insurance, or other third parties are excluded and cannot be claimed. This credit is equal to a percentage of up to $3,000 of qualifying expenses for one dependent, or $6,000 for two or more. The percentage depends on the taxpayer's adjusted gross income. The highest credit rate is 35%, and it gradually decreases to 20% for high-income taxpayers. Importantly, the taxpayer must provide the care provider's full name, address, and taxpayer identification number on Form 2441, which is a child independent care expenses form. Failure to provide this information will result in disallowance of the expense. Additionally, receipts and proof of payment should be retained in case the IRS requests documentation. The federal tax code allows taxpayers to deduct unreimbursed medical expenses for themselves or their dependents, but only to the extent that the total amount exceeds 7.5% of adjusted gross income. This means that the first 7.5% of medical expenses is not deductible. Only the amount that exceeds that threshold may be claimed as an itemized deduction. Qualifying medical expenses are defined broadly and include diagnosis, treatment, mitigation, and prevention of disease, as well as costs for services that affect the structure or function of the body. For families supporting an individual with a disability, eligible expenses may include therapy, nursing, care, and rehabilitation services, so long as they are prescribed by a healthcare professional. Home modifications made to accommodate a disability, such as installing wheelchair ramps widening doorways, modifying bathrooms, or lowering countertops. Transportation costs to and from medical centers or therapy sessions, including mileage, public transit fares, and ride services when used for medical purposes. So these deductions are available only when the taxpayer chooses to itemize deductions rather than take the standard deduction. In addition, the taxpayer should maintain detailed records, including invoices, receipts, physician statements, and proof of payment, as this documentation may be required to substantiate the claim, rather the deduction, if questioned by the IRS. A special needs trust is an important planning tool that allows a family member or other third party to provide financial support to an individual with a disability without disqualifying that individual from means-tested government benefits such as supplemental security income, SSI, and Medicaid. These trusts are specifically structured so that the assets held in the trust are not considered available resources to the beneficiary for public benefit purposes. Funds in a special needs trust may be used to pay for a variety of supplemental expenses, including education, transportation, assistive devices, therapy not covered by insurance, and recreational or social activities that enhance the beneficiary's quality of life. Importantly, the trust should not be used to pay for basic support items, such as food or housing, if the beneficiary is receiving SSI, because those payments may be reducing the monthly SSI benefit. Taxation depends on how the trust is structured. In some cases, trust income is taxed directly to the beneficiary. In other cases, it is taxed at the trust level. Proper drafting is essential to make sure the trust complies with both federal and state benefit rules, and it is strongly recommended that the trust be prepared by an attorney with experience in special needs planning. Failure to use the correct form of trust can inadvertently disqualify the beneficiary from receiving public benefits. ABLE accounts are tax-advantaged savings accounts that allow individuals with disabilities to save and invest the money without losing eligibility for means-tested public benefits. To qualify, the individual's disability must have begun before age 26, and the individual must meet the Social Security definition of disability or possess a design or designated disability certification. Contributions to an ABLE account can be made by the account owner, family members, or other third parties and are limited to a total of $19,000 per year. If the account owner is employed and not participating in an employer-sponsored retirement plan, an additional contribution equal to the lesser of the owner's compensation or the federal poverty level may be made. The funds in an ABLE account grow tax-free and withdrawals are not subject to income tax as long as they are used for qualified disability expenses. Qualified expenses include a broad range of categories such as housing, education, transportation, assistive technology, basic living expenses, legal fees, and personal support services. Importantly, the first $100,000 in the account is excluded from the Supplemental Security Income SSI resource limit. Once the balance exceeds $100,000, SSI benefits are suspended but not terminated, and they resume automatically when the balance falls below the threshold. Medicaid eligibility is not affected regardless of the account balance. The Earned Income Tax Credit is a refundable tax credit that is designed to assist low to moderate income workers and families. A refundable credit means that if the credit exceeds the amount of tax owed, the taxpayer will receive the excess as a refund. The credit may be claimed when a qualifying individual with a disability is treated as a dependent and the taxpayer has earned income within the IRS limits. Significantly, disability benefits such as Social Security Disability Insurance, SSDI, or Supplemental Security Income, SSI, do not count as earned income for purposes of the credit unless they represent compensation for actual services performed. Eligibility for the credit and the maximum amount of the credit both depend on the taxpayer's filing status and the numbers of qualifying dependents. Each year, the IRS publishes an income table identifying the income thresholds and maximum credit amounts. Taxpayers must meet all other EITC requirements, including the requirement that the qualifying individual have a valid Social Security number and reside in the United States for more than half of the year. Under the Internal Revenue Code, individuals who withdraw funds from qualified retirement plans before reaching age 59 and a half are generally subject to a 10% early withdrawal penalty in addition to regular income tax. However, one of the key exceptions to this penalty applies to individuals who are permanently and totally disabled. To qualify for this exception, the disability must be certified by a licensed physician and must prevent the individual, from engaging in substantial gainful activity. A statement from the physician should be retained as proof of the medical condition. It is important to note that this exception applies only to withdrawals made directly by the disabled individual from his or her own retirement plan. Parents or family cannot use the disability exception to avoid the penalty on withdrawals from their own retirement accounts, even if the funds are being used to pay for care or support of a disabled dependent. In addition to this narrow exception, some employer-sponsored retirement plans may allow hardship withdrawals for disability-related expenses or to prevent eviction or foreclosure when significant medical costs are involved. Hardship withdrawals are subject to specific plan rules and may still be taxable, so it is advisable to review the documents carefully and consult with a tax advisor prior to taking a distribution. Certain education-related expenses may be deductible as medical expenses when they are incurred primarily for the treatment of a disability rather than for general educational purposes. For example, tuition paid to a school that provides speech therapy, occupational therapy, or other specialized programs tailored to the student's disability may qualify as a deductible medical expense. The IRS generally requires documentation indicating that the enrollment was recommended or prescribed by a physician and that the primary purpose of the program is therapeutic. In addition to tuition, related costs such as transportation, meals, and lodging may also be deductible if they're directly associated with receiving medical care. These expenses must be reasonable and necessary and should be documented through receipts and statements. Taxpayers should evaluate whether to use a traditional 529 college savings plan or an ABLE account, depending on the nature of the expenses and the individual's eligibility. A 529 plan is generally used for post-secondary education, while an ABLE account offers broader flexibility and can cover a broad range of disability-related expenses. Current law also allows a tax-free rollover from a 529 plan into an ABLE account up to the annual ABLE contribution limit. Any amount rolled over counts toward that annual limit and must be coordinated carefully to avoid exceeding it. When planning for disabled individuals' financial support, it is critical to understand the resource and income limits that apply to means-tested government programs, particularly SSI and Medicaid. These programs impose strict eligibility rules. In general, the beneficiary cannot have more than a modest amount of countable income or assets. If the individual receives direct cash gifts, inheritance, or other financial support, those amounts are treated as countable resources and may cause an immediate reduction or even a complete loss of SSI and Medicaid eligibility. The same can occur when payments are made directly for food or housing, which the agencies consider in kind, support, and maintenance. To prevent this, families are encouraged to use special needs trusts or ABLE accounts to hold funds on behalf of the disabled individual. Assets held in properly drafted special needs trusts are not counted as the beneficiary's personal resources, and distributions can be made for supplemental needs such as transportation, assistive devices, and enrichment activities. Similarly, ABLE accounts allow up to $19,000 in annual contributions and protect funds up to $100,000 from being counted towards the SSI resource limit as long as the withdrawals are used for qualified disability expenses. Because the rules governing eligibility and the interaction between tax benefits and public benefits are complex, professional planning is strongly recommended. Working with a qualified attorney or financial advisor helps ensure that tax strategies, trusts, and saving plans are properly coordinated and do not inadvertently jeopardize vital government support. So here's some key reminders from what we've gone through in this presentation. So when applying these tax rules, the most important steps to determine whether the individual with a disability can be properly claimed as a dependent because eligibility for almost every other benefit flows from that starting point. It is then helpful to review the full range of tax provisions that may apply, including the child independent care credit, the medical expense deduction, able account contributions, and the use of special needs trusts, and to select the options that best fit the individual's specific situation. Finally, it is essential to coordinate tax strategies with government benefit rules. Certain types of financial support can unintentionally reduce or eliminate SSI or Medicaid eligibility, so special attention should be given to how funds are contributed, held, and distributed. When in doubt, consulting a qualified tax or special needs planning professional ensures that the family receives the available tax benefits while still protecting access to essential public programs. So that's all for today's presentation. Thank you all for listening. And again, since our services are free, donations are crucial for our support and expanding our reach. Monetary donations are greatly appreciated. Additionally, those who can volunteer their time, expertise, or spread awareness are a great help. If you had any questions about anything during the presentation, please email us at info@taxpayershelpcenter.com and your questions will be answered by a tax professional. So with that being said, thank you all for listening and have a great day.